I want to talk to you a little bit about some 1031 exchange considerations. I've had quite a few members over the last 3, 4, 5 months, whether it's at Blueprint Days or just asking one-off conversations, having questions about 1031. For those of you who are not familiar, when you own an investment property, rental property, land, your office commercial building, something you hold for investment, when you sell an investment like that you've held for a year or more, then it's subject to long-term capital gains. If you hold such property for less than a year, typically that's called dealer property, and you pay tax at the ordinary income tax rate, which is much higher than long-term capital gains. So the idea first is to consider really what investment property is, and if you decide to sell it, you sell it and you're going to pay long-term capital gains tax on the profit, Now, I'm not going to go into the weeds on how to establish that. It's not difficult. Your CPA will have those numbers. So if you want to determine what's my tax going to be on selling my office commercial building, your CPA can tell you, and you should go there first. How much actual tax liability will you have before you need to consider a 1031 exchange? I'm a fan of 1031 exchanges. I've done them before in my life. In the current climate, the current economy, it's difficult to do. Even for pros who are out there and have connections to lots of different investment opportunities, finding another property to move or transfer or exchange the equity from property A, exchanging it to another property or properties, you can do multiple properties, it's hard to do today. Why? Well, because the delta between the ask and bid price is still too wide. In other words, property values overall have not come down enough in coordination with the higher interest rates. They will. They're going to come down. But right now it's hard to find. There's still money chasing deals. There's still people who are speculating in the equity markets right now, and therefore trying to find another property that's suitable is going to be difficult where it makes sense. The property you're giving up, potentially selling, is property that you have had and held in your portfolio. It could be your office building, it could be some rental properties that you know, and you know what they produce. You either like them or you don't, and you're potentially selling because you've got a good enough offer from a buyer and you want to take the deal, but gosh, can I possibly save on taxes? Well, remember, it's not saving or eliminating taxes, it's deferring tax. Again, nothing wrong with that. But the problem is finding a suitable replacement property or properties within the time frame that the 1031 exchange allows you to do. You've got to essentially designate the potential property or properties you would exchange into within 45 days of closing on the sale of your one property, and then you have to close on the other exchanged property or properties within 180 days. Hard to do in this market. So what would I do today? If I had a 1031 exchange possibility because of an investment property I was selling for the right reasons, I would look at moving that equity into mineral rights. You may or may not know, but mineral rights are 1031 tax compliant, meaning mineral rights count. Why? Because when you own mineral rights, you own a deeded interest. That's the key, a deeded interest. You hold it in your name or your entity's name. We can own rental properties, which I have owned rental properties, and you could have an outside manager manage those rental properties. It's still, you have the deeded interest in those, right? So that's what makes mineral rights 1031able. So the reason I like that is a possibility for what I call warehousing, but warehousing your 1031 exchange. What do I mean by warehousing? Well, keeping that long-term capital gain tax liability on the profit that you want to move and not have the tax bite come out of, you can move it to mineral rights and warehouse it there. Warehouse it meaning leave it in mineral rights. Leave it in mineral rights for 2 or 3 or 4 or 5 years, maybe longer. Maybe you actually like the mineral rights and it's actually producing what you want and you actually see the value in it. But even if you want to go back into, say, real estate equities, real estate being the standard equities of property or properties that we like, then you potentially could move or sell your mineral rights and then exchange your mineral rights basis into the next property down the road when maybe it's easier to find properties. Maybe we've gone through the correction in the marketplace and now there's equity opportunities in single family houses or maybe some multifamily. The key is you've got to go from deeded interest in the property you give up to deeded interest in the replacement property, and then if you want to keep that going, you've got to keep going into a deeded interest. I cannot do a 1031 from a deeded interest in a property to a syndication. or to a real estate fund doesn't count because I don't have a deeded interest in those investments. I have a membership share. Doesn't count. I have to go from deeded interest to deeded interest to deeded interest. So my point again is you could go into mineral rights and then 2 or 3 years you could sell. Now, here's the question. Who am I selling to? Well, there's no guarantee. This is just my bias in my thinking is that there's going to be enough fervor and demand for mineral rights. This is my opinion. You have to decide what you think. But I believe that the demand for fossil fuels is going to put a premium on the value that one has, not just in the cash flow dividends, which I think are going to be significant, but also in the actual value of that holding entity in the mineral rights, which means if I want to sell some portion of my mineral rights down the road to another third party, I think it's going to be very doable. I think it's going to be very doable. No guarantee. But if things go the way they are, I think you could do that. And realize there's always people that are coming and going with their assets. And that's what makes a market. We have such a market in Freedom Founders. We have over 120 members going different ways, different directions with assets and investments. And even within our community, we have an ability to cross-pollinate each other in investments, whether it's from self-directed IRAs, qualified accounts, taxable money. I mean, there's so many ways to work it that you're never really stuck, even though people say, well, real estate is illiquid. Well, generally speaking, on a relative basis, it is. But you can make it less illiquid by who you know, financial friends, a network of other investors who are like-minded. And I think that's what we have in the Freedom Founders. And therefore, I believe that doing a 1031 to warehouse for a few years, or maybe just for a long time duration, mineral rights could be a good play. I'll leave it there. Remember, always get specific advice on your situation with your tax accountant and your CPA before you make any moves. It's important to know your situation, but these are my general observations, and I'll leave it there. Hope that's helpful.